FICO sells 10 billion scores every year, 4 times the number of McDonald's burgers and twice the number of Starbucks coffees sold annually. According to the company itself, 9 out of 10 lending decisions rely on FICO.
It's a company that's as important as any regulated monopoly, yet its pricing power isn't actually regulated. They can and they have raised pricing dramatically in the last few years, which is partially how their operating margins have been able to more than triple since 2019. When Americans talk about their FICO score, they're referencing a specific product from a specific company, and yet the term has really become synonymous with creditworthiness itself, like other dominant businesses whose names have become synonymous with the services they offer, from Ubering to Googling. I've even heard ChatGPTing by now. FICO's linguistic and cultural relevance reflects a business with as deep a moat as any out there in fair ISAC Corp, whose ticker symbol is fittingly FICO. And if you're not familiar with FICO, the company's credit scores are used by about 90% of the top lenders in the US, making the company's algorithm the de facto gatekeeper for American consumer finance. So, Shawn, what do you say? How's that as a setup for today's pitch?
It's a great teaser. And like you said, just about everyone in the US will be familiar with the company. And then, yet, for the rest of our audience, there's maybe a decent chance they've never heard of FICO. But still, I mean, it's so impressive to think about how long they've dominated this niche. And, I look around and, Google has been around for what, 20 years and even less for Uber and Facebook. And still, these are companies with massive market share that are synonymous with the services they provide. Like going to say you're Googling something, even if you don't even actually use Google, but that's a relatively new phenomenon. And meanwhile, FICO has monetized its algorithmic moat for decades. Turning what began as a small consulting firm in the 1950s in California into a financial technology powerhouse. So, like we've said, is really synonymous with personal credit in the US. And its shares have just done ridiculously well, gaining on average 30% a year since the crash of 2008. And I mean, that outperforms even the NASDAQ 100, which is, of course, home to the FANG stocks we always hear about. So it's not too shabby.
So, we will get into the backstory of all of that in a moment, but that incredible run seemingly came to a sudden halt this year. I think it was in July of this year, with FICO shares being down more than a third at the time of recording today. So, my understanding is that this is largely due to new regulatory concerns for a stock that was also, as we kind of discussed before the episode, trading at a fairly premium price, and rightfully so because the business quality is just incredibly good. But under the Federal Housing Finance Agency's new director, Bill Pulte, the agency has moved to allow mortgage lenders to use a competitor's model, which is called Vantage Score 4.0, alongside FICO, when originating mortgage loans for Fannie Mae and Freddie Mac. And just for context, as you can imagine, FICO scores are a pretty integral part of the mortgage application process. So any hint of shifting to using another metric, like Vantage Score, for example, is going to cause a ton of angst among FICO investors.
It all stems from a post on X where Bill Pulte said something along the lines that if you use Vantage and not just FICO, for the betterment of the American people and the consumer, you should get better pricing. It's just math, predictive math. So, yeah, for years, only FICO scores were accepted for government sponsored mortgages, which account for nearly half of all new home loans. And an earlier regulatory proposal would have required both Vantage score and FICO scores on every loan, but that drew a good bit of industry pushback over the cost and complexity of doing so. And the latest approach pushes the industry closer to the system where lenders get to choose which one they want to use instead of specifically being mandated to use one or both.
We talked about all of that a bit before the episode, and of course, we'll talk about it here as well. But before we get into the nitty gritty here, let's just take a small step back and make sure all of our listeners are on the same page because, some people might not know FICO. So, what is it that FICO really does and how do they create value? Because I'm sure they're not allowed to be a monopoly just for the sake of being one. So, presumably, there's a good reason why they have become the industry standard.
Right, right. Well, for the most part, we all have credit scores, and we consumers are the ones who are actually paying for that credit scoring, even if we don't necessarily realize it because it's done indirectly. And when someone is thinking of buying a house, like me earlier this year, they visit a mortgage lender, and that lender must buy a credit score from FICO and also the major credit bureaus, either Experian, TransUnion, or Equifax, to see what the person can afford. And then when a customer takes out a loan, the mortgage banker has to purchase another, more complete report of their credit information. And even if a lender thinks the customer would be a good risk to take based on their own analysis, the lender still is going to buy a FICO score almost regardless, because a worthy FICO score is really the industry standard stamp of approval that allows banks to then repackage and sell the mortgages they make to investors who purchase these different bundles and tranches of thousands of mortgages across the US in mortgage-backed securities. And that matters because mortgage bankers don't actually carry the capital to hold the mortgages they make on their own balance sheet. Your local bank does not actually want to lend you money for 30 years for you to buy a house with, broadly speaking. They are just there to facilitate the loan initially and then ultimately resell that loan to investors down the line who do want to take on the risk through purchasing mortgage-backed securities specifically. So your local bank will make a mortgage loan and then send it onward to the capital markets, essentially. And before your mortgage ends up the basket of others on Wall Street, though, the government guarantees it through Fannie Mae and Freddie Mac. And with a stamp of approval from Fannie Mae and Freddie Mac, now also largely stemming from that original FICO score, they're looking at the same score too. The guaranteed mortgages are then sold to the Wall Street industrial complex, for lack of a better word, which is going to package them up and make them available as investments for folks across the globe. In Germany, Daniel, you could invest in mortgage bonds from the U.S. It's a pretty popular product, and so for anyone who has ever watched The Big Short, and actually this episode inspired me to watch it this past weekend with my wife, or really just anyone who's gone down the 2008 financial crisis rabbit hole. I think a lot of these terms will sound familiar: mortgage-backed securities and credit bureaus and Fannie Mae and Freddie Mac. But I mean, it's just objectively a really messy and complex process that it leans on this standard methodology for pricing the loans and assessing the risk being taken. And that standardized methodology, for better or worse, is FICO's scoring algorithm. That is what consumers, lenders, investors, regulators, they've all landed on the same thing. And you combine that with the underlying credit data from the major credit bureaus I mentioned, that's how you get FICO score. So FICO score is just the algorithm, but they don't actually own the underlying credit data.
It's been a while since I watched The Big Short, but I think FICO's role in the great financial crisis is pretty interesting, right? I mean, we often hear about the failure of rating agencies like Moody's, S&P, or Fitch, and at first glance, you might think FICO should be involved there too, as well, right? I mean, anyone who watched The Big Short or has just studied the financial crisis, and I do not say you studied the financial crisis for watching The Big Short, but still, you would think, okay, well, there were so called prime loans and subprime loans. And generally speaking, prime loans were the one given to people with a high FICO score, and subprime loans were loans given to people with lower FICO scores. And the problem was in the financial crisis, the bundling of these loans. So prime loans were bundled with subprime loans. And those products were then rated by Moody's, S&P, and Fitch. And FICO wasn't really involved in that anymore, but many of the prime loans failed as well. So FICO is not a perfect proxy, of course, for repayment ability. And that plus the over reliance on those scores, I mean, it didn't help the financial system either, right? But FICO is, as you kind of mentioned, similar to many international versions. So in Germany, for example, we don't use FICO scores, but we have something similar called Schufa. And Schufa's result is not a numerical score. So they wouldn't say you have a credit score of 720, but they have a percentage score. So that is supposed to tell banks or other institutions the likelihood of a loan being paid back. And beyond that, I would say they pretty much serve the same purpose. They rely on similar data sources and statistical models. They're just supposed to lead to better credit conditions overall.
Right. Yeah. If FICO's ubiquity in consumer credit underwriting is a pretty poorly kept secret, honestly. Every few years, it gets a lot of attention from regulators, but it's just such an essential part of the mortgage lending market and these other parts of consumer finance, while also coming at such a small relative cost, which I think we'll talk more about. But it ends up being pretty trivial to target them. And it's sort of like how Visa takes a very small cut out of every transaction that occurs on the Visa network globally. And on the one hand, That's going to rub a lot of people the wrong way and look like this unfair toll road. But when you think about how useful the Visa network is in facilitating payments essentially instantly, for Visa to take a very, very small percentage on every individual transaction, it actually seems relatively fair. And even if regulators wanted to try and take action on behalf of merchants and consumers, there are probably much more consequential areas to focus on that will drive more meaningful results than trying to just force Visa to take an even smaller cut, for example. So, I mean, I know you know Visa very well, Daniel, after having pitched it to our portfolio for a few months back, but the dynamic is similar to FICO, where when you close on a house, there can be thousands of dollars in costs, with a lot of that being things like titling fees, taxes, and realtor commissions, and all that kind of stuff. And FICO's cost might just be $5 baked into that overall closing cost pie. So it's a rounding error. And so, like I said, if you're trying to genuinely reduce the cost of buying homes for Americans, I would think politicians attacking FICO, it's not really going to move the needle much. It's going to be way more productive to narrow in on titling costs or realtor commission structures. And I mean that's sort of a tangent, but I'm just trying to make it clear that for as useful as FICO scoring is, in my opinion, the cost is very, very minimal. And really the bigger point is to say there could potentially be a lot of runway left for them to continue raising prices, given how important they are and what a small relative share of the overall cost structure that they make up.
It's pretty close to what Visa does, and especially that it's kind of more like a volume game, and the pricing for them, there's just a lot of runway left to go. But I guess the main difference is that Visa holds its strong market position because it is a product trusted by both consumers and the merchants, so basically on both sides. And with FICO, it can feel like it was just given a monopoly by the government, although you, for example, would say that's not necessarily the case, and we will get into why exactly. But when that's the case, there might be some more political pressure to act appropriately, or someone will step in. And that's not so much the case with Visa.
I think that's right. And with the question of FICO's monopoly, whether it's rightfully earned or kind of granted by the government, either way, it's a poorly kept secret that it's a monopoly. I mean, you have a number of different entities that basically acknowledge that openly. In last year, for example, the Community Home Lenders of America Association said the following about FICO, quote, the combination of FICO's extremely high market share and the fact that Washington agencies require lenders to use this company's products means that FICO has unilateral, solid gold market power, the type rarely seen in any US industry short of highly regulated utilities, whereby rates are set by public utility boards or commissions. And so, solid gold market power, like a highly regulated utility. I mean, that is quite the moat to have. That's quite the endorsement. And we know that FICO's pricing power, at least not currently, really is not regulated in the way that an electric power company is. And they're still an essential service, and they have a lot of discretion over their pricing, which is how you get a company that's been around as long as FICO, still compounding by double digit percentages every year and boasting 40% free cash flow margins and 38% average returns on capital over the last 5 years, because it doesn't take a lot for them to raise prices. There's not a lot of friction. And yet all of that price rate increase is going to drop to the bottom line for the most part.
A couple of episodes ago, we covered Berkshire Hathaway, and we also talked about BNSF, and we talked about the energy business. And they are decent businesses because you can put a lot of capital into them. Most importantly, though, they are duopolies or oligopolies, but they are regulated. And it feels like FICO is kind of in the same position, but they're not regulated enough. So they can just keep on raising prices. And I mean, I just have the numbers here in front of me, and they look incredible. I mean, there's a good reason why when you look at a list of the so-called highest quality companies in the S&P 500, FICO always ranks at or at least pretty close to the top. And I mean, we'll get into what makes this business so special and so profitable. But I do think it is a story where the origins are particularly relevant. And we need to know what it was like to kind of get a loan before FICO to really appreciate how much things have changed for the better since FICO came into the business.
The Fair Isaac Corporation story goes back to 1956. The company was founded by Bill Fair, an engineer, and Earl Isaac, a mathematician, who met each other at the Stanford Research Institute. And they started this consulting firm with $400 of their own money, which was probably a decent amount of money in the 1950s. And they operated out of a studio apartment in San Rafael, California. And the core idea was to intelligently use data to improve business decisions at a time when I would say that was much more of a novel concept. It sounds like almost every business today, but we have to remember this was the 1950s. And to your point, before FICO, lending decisions were largely subjective and based on these kind of questionable factors like somebody's perceived trustworthiness or personal familiarity to the lender with no concept of variable interest rates based on true credit risk. And Fair and Isaac aimed to essentially bring standardization and objectivity into the lending process, making a whole thing a whole lot less susceptible to biases that don't actually reflect credit risk. And you can imagine at this time, your skin color or gender could play a really significant role in a banker's decision to lend to you, even if those considerations obviously have zero to do with the actual chance of you being able to repay a loan. And so FICO's first credit scoring system was launched in 1958, and it focused on factors like age, occupation, and income to assess credit risk with instead of relying on people's hunches almost.
I'm imagining this kind of old-timey bank where you just walk in and ask for a loan, and really depending on whether they like you and your story or not, they decide to give you a loan. And I'm sure that's a bit of a simplification, but also due to my research for my visa episode, my understanding is that it's not too far off either. And the other thing is that there was just one lending rate at most banks. So everyone would pretty much get the same mortgage rate. So, for example, regardless of whether you are more or less creditworthy than someone else. And that just makes the whole system much more inefficient because ultimately you're punishing more creditworthy people and also raising the threshold for anyone to even get a loan, right? So today, if you are deemed a poor credit, at least you can still access capital through a higher interest rate, right? Instead of being completely rejected as would have happened in the past. And I just finished watching a crime show, and I know that's a bit of a tangent, but I still want to go there. So the following comparison might be a stretch and only come to my mind because of that. But it kind of reminds me of how DNA evidence completely turned around the legal system and basically the world of law enforcement upside down, making it much less of a pseudoscience and more of an actual science. And that feels like what has happened in consumer lending as well, thanks to credit scores. They are imperfect, sure, but they still do a much better job at predicting lending risk without explicitly discriminating against people or just leaving the decision basically up to a given banker's subjective thinking to the same extent as that would have still been the case just 70 years ago.
Yeah, I think that's a really helpful comparison. I mean, lending was something of a pseudoscience back in the day, as you said, and being more religious, for example, and being seen at church weekly could actually make it more likely that you get a loan. I mean, that just sounds ridiculous today, but there are certainly these instances of things like that from the past that we can see. And again, that's not saying anything about religion, but just that I don't know your employment status, income, and history of repaying bills are probably just a bit more relevant for your loan decisions. And obviously, I mean, they needed large data sets to combine with their mathematical models of credit risk to refine these systems over time. So FICO's early scoring systems were not universal and were actually really custom built for specific banks and different financial institutions and their needs. And these systems helped lenders adjust standards based on more objective scores and ultimately compare loans across locations, which is what led to a universal FICO standard arising. But I mean, yeah, I mean, think about it. If you oversaw a network of 12 regional banks across New England in 1952, how would you actually quantify and adjust for the amount of credit risk you're taking across your portfolio and the different branches? And I mean, there would have really been no good way to do that accurately. Credit scores are calculated using the same metrics and inputs for everybody. And that makes the whole process more universal, which doesn't just help people trying to get loans, but clearly it also helps the banks better understand the risks they're taking. And that can actually make them feel more comfortable with making more loans and really just allows them to take on more risk once they actually understand the full picture of what's going on. And or maybe they can scale back as needed to avoid a 2008 financial crisis type scenario. And so, I mean, that is an immensely valuable service to everyone involved. I think, obviously, and to customers, to banks, and then later down the road to the investors who would eventually get more involved in buying mortgages through mortgage backed securities. And, if you know how many mortgages you have outstanding to people with 650 FICO scores versus 750 and 850, that tells you a lot about your lending portfolio as a banker with a level of precision not otherwise possible if you don't reduce the most important lending factors down to a single fungible number. Even Einstein had blind spots. That's why modern science is built on the idea of peer review. Investing may be more art than science, but that doesn't make peer feedback any less valuable. The tricky thing is finding qualified people who are interested and willing to help vet your investment ideas. That's why we built the Intrinsic Value community. It's a place to connect, share ideas, learn, and get feedback. Nobody ever wishes they'd spent more time buried in spreadsheets, but connecting and building relationships with others who may be smarter on a topic than you, but who are also schooled in value investing, that's valuable. We make spots in this exclusive community available in cohorts every few months, and last time around, our 30 available spots filled up pretty quickly. If you're interested in our next cohort, which will be even smaller, you can join the waitlist at theinvestorspodcast.com/intrinsic value community. That's theinvestorspodcast.com/intrinsic value community. Look, every hunter, camper, and backpacker needs one of these. That is a Harvest Right freeze dryer, which lets you preserve your own meals and snacks. It's perfect for your next backcountry adventure or hunting trip. You can fuel your adventure with freeze-dried strawberries, bananas, pineapples, and even full home-cooked meals. No more relying on expensive store-bought, preservative-packed food. You can also preserve wild game with your Harvest Right freeze dryer. That's right, take control of your harvest by freeze-drying venison, elk, or fish so you'll always have high-quality protein ready to go. And your pets will love the freeze-dried treats too, just like my dog Riley. Freeze-dried meals are lightweight and long-lasting, staying fresh for up to 25 years, yet they taste just as good as the day you made them. Whether you're hunting, camping, or prepping for emergencies, a Harvest Right freeze dryer keeps you ready for anything. It's like having extra cash in your portfolio to take advantage of downturns in the markets. That's how I think about it, at least. Learn more by visiting harvestright.com/investors. That's harvestright.com/investors. Just like everybody else, there was a time when I was a beginner investor, and I have to say, investing is particularly filled with jargon that can just make it so difficult for new investors to understand what is going on. But it's never too late to get smarter about stock investing from the ground up. At the Investors Podcast Network, we've made a habit of studying the world's best investors, and now I'm distilling those learnings into a simple course for you, or for anyone in your life who you might want to share the gift of knowledge with. With my How to Get Started with Stocks course, you can master the principles of excellent lifelong investing with valuable insights for both beginners and pros. The course covers 10 different sections, beginning with the basics of what a stock actually is and how the stock markets work, to strategies to optimize your retirement savings, how to pick great companies for the long term, what to look for in ETFs, and how to monitor your investments, plus so much more. To begin getting smarter about investing, just visit theinvestorspodcast.com/get started with stocks. That's theinvestorspodcast.com/get started with stocks. And for a limited time, you can use code STOCKS15 for a 15% discount at checkout.
I guess it's pretty obvious that this has been a real paradigm changer, and just a great example of how neutral middlemen can actually make an entire system better off rather than trying to have every bank assess credit risk completely on their own without any standardization. And I would say middlemen usually get a bad rep, but this is a case where you do need an objective third party to just help standardize things, right? And there's some debate about whether a for profit company like FICO should play that role for society, or whether it would be more appropriate to have the government do this. So we should emphasize that people still very much have concerns with the fairness of FICO scores. Although you can't discriminate based on race, there are some subtle ways that the wrongs of the past can still work their way into credit scores and impact folks' access to financial resources. I mean, one of the most important factors in a credit rating is the length of your credit history. And if you were a woman or a person of color who couldn't get a loan historically, well, then you had no chance to build up that credit history, which basically means you may not have been able to help your kids and even their kids to build up credit too. And part of that comes from the fact that mortgage payments are included in credit history, but renting is not. So if you were rejected for a mortgage, you're just trapped in a cycle where it's just harder to build a credit history. And given that FICO scores get pulled for everything from credit card applications to job applications, and even when applying for apartments, that can be a real issue. If you never had credit, then you're assumed to be a bad credit risk, for better or worse, which can create this negative flywheel that reinforces itself and just leaves a chunk of the population disadvantaged in getting certain jobs or loans to, buy a house instead of renting indefinitely. And all of that is relatively complex. So maybe you can give us a bit more insight and just tell us what exactly goes into a FICO score.
Broadly speaking, it's just a reflection of your history of completing payments, how much you owe, how long you've had a credit history, as you mentioned, the types of credit you have, and whether you've added any new forms of borrowing recently. So if you take out a massive loan recently, it could either, in some cases, it could actually help, or in other cases, hurt your credit score. And what they're doing with that info is statistically weighing these various factors to determine the probability of someone defaulting on their loans. And crucially, FICO score is very effective at rank ordering credit risk across the US population. Otherwise, it would not have become the industry standard. And it's just like it's great at reliably separating higher risk borrowers from lower risk ones. And we've seen that validated by decades and decades worth of lender data, really, and the losses that they've realized. And to your comments on how historical biases and discrimination can work their way into credit scores, FICO's competitor, VantageScore, which is this joint venture formed in 2006 by the three credit bureaus in response to FICO, I mean, it has tried to be more inclusive. That has also pushed FICO to try to be more inclusive. And so, for example, VantageScore 4.0 can score people with as little as 1 month of credit history or even just one account on file. And it can also leverage non-traditional data, you might say, like your rent payments, which, as you mentioned, normally wouldn't be counted, even though, in my opinion, that does reflect a history of reliably paying a financial obligation, which should be relevant. And, I would say on the one hand, it enables more people to get a score. Like VantageScore says this new model can provide scores for 33 million Americans that traditional models wouldn't be able to. But at the same time, FICO argues that this data isn't as proven for actually assessing credit risk, which is ultimately what matters. And FICO CEO has really not been shy about saying that Vantage scores optimize for inclusivity over actually assessing credit risk, while at the same time warning that a score based on less rigorous credit criteria could actually undermine loan safety and see more defaults because the predictive power is being lost. So, I mean, you can take that insight or leave it, but the reality is that they've been competing with VantageScore for over a decade, almost 2 decades, and they've seen no significant market share loss in that time.
I mean, I would say the CEO of FICO definitely has an incentive to say that, right? But intuitively, more data points should lead to better results. So he probably has a point too. I mean, I guess the best predictor of quality is how many institutions actually use the scores. And as you told me, and as you mentioned now again, FICO has been and it still is the number one. And beyond that, I guess it's just hard for us to get more insight. I mean, neither of us are professionals at modeling credit risk, right?
For sure. And really, if you come away with nothing else from this episode, just know that the system for borrowing money, in my opinion, is way better than it was. And over the years, FICO has continued to try and refine its scoring system to be able to rate millions more Americans. But really, the most significant development came with the Equal Credit Opportunity Act that was passed in 1974, which accelerated the need for objective scoring as it made discrimination based on factors like gender or marital status illegal. And just to continue with the timeline of the FICO story here, through mergers and acquisitions in the 70s and 80s, the three major US credit bureaus, Equifax, TransUnion, and Experian, emerged. And FICO's mathematical models were combined with the credit bureau's consumer data to release the first standardized credit bureau risk score, known as pre-score, in 1981. And the modern FICO score that many of us know, that ranges from 300 to 850, was released in 1989. And it really became ingrained, though, in 1995 when Fannie Mae and Freddie Mac institutionalized FICO scores by requiring their use for all mortgage originations they handled. So that was that stamp of approval we mentioned earlier. And that cemented FICO's industry standard status because there was essentially no option to not use FICO, at least as a bank. If you wanted Fannie or Freddie to be able to purchase a mortgage from you, you needed to have a FICO score from the underlying borrower, and you were going to have to pay for that. So, but FICO largely has Fannie Mae and Freddie Mac to thank for its hold on the securitization market, which is a fancy way of saying the mortgage-backed securities that investors are buying that are bundling together these mortgages. And once lenders were using FICO for mortgages, they really moved to using it for nearly everything else in consumer finance beyond just mortgages.
I think what followed was a pretty interesting dynamic a couple of years later. I think it was in 1995. And at that time, FICO took this role of basically being a government sanctioned monopoly. And perhaps because they were worried about abusing their privilege, they went almost 25 years without raising the price for FICO scores at all. They relied entirely on volume growth. So basically, more people applying for things like mortgages over time, requiring more FICO checks. And that basically was what drove the business success. But then in 2018, that changed. And as you told me, it changed pretty dramatically to an extent that they've now been very aggressive about taking price. So my question for you, Sean, is what happened? I mean, isn't it a bit weird to go so long without raising prices and then suddenly just do a 180? I mean, did volume growth come to a halt or did something change that made them just more comfortable in their monopoly positioning?
I had the same questions when I first looked at this. And I mean, FICO began revamping its pricing strategy and instituting special price increases for various types of scores that it produced, beginning with a 30% increase in the price to access FICO's mortgage scores for banks. And then the cost of pulling FICO scores for auto loans and eventually credit card scores rose too. And from a shareholder's perspective, these price increases had added substantial annual revenue with very high incremental margins. And just to translate that into plain English, there's no extra cost for FICO when they raise prices. So all of that price increase really just becomes profit. And that is a special thing. With a manufacturing business, you can't really just raise prices in the same way. You actually have to sell more stuff, generally speaking, to grow the business. Otherwise, you're going to see an offsetting drop in sales volumes as people move to your competitors. But FICO really has no competitors. And FICO can raise prices 10%. And without really a significant alternative, sales volumes won't fall off in any way. Meaning, without any increase in the number of times their scores are used, they can correspondingly increase profits by 10% or more with just a 10% price increase. And that is a pretty tempting lever to pull. So it's amazing they went so long without doing it. And I'll just say, to show the point as to why I say 10% or more, that's because if you raise prices 10% and all of that incremental revenue falls to the bottom line, then with the same total sales volumes, you actually would increase your overall profits by more than 18%. So I did the math, so you don't have to. You just take my word for it. But that is operating leverage in a nutshell. And it's something we talk about from time to time. But that's the math behind it. Being able to scale your business with no incremental costs is a really, really good thing for profits.
Yeah, we love to talk about it every time. And I mean, we want to go into these high quality companies, right? So whenever we can find operating leverage, we love to talk about it because it's a very powerful concept and why we like low capex and monopoly like businesses so much, right? To maybe take a quick step back and just explain why profits increase by more than 80% when revenue actually only increases by 10. I know it's pretty easy to understand for every one of us who went to business school and learned it, but I think it's not trivial to just the average listener. So basically, when you don't have to spend any money on new employees or machinery to sell a new product, the extra dollars from price increases, they are layered on top of a fixed cost base. And what that means is that the margin on each new dollar generated is higher than the average margin. And so profits increase more than revenue because you basically multiply the extra revenue by a much higher margin than before. And of course, as you said, this wouldn't work in a more competitive industry because you just can't raise prices like that. Higher prices would cut into sales volume, which cancels out the benefit. But that's what makes a company like FICO so attractive because with so little real competition, it's just an incredibly powerful concept. And Just to circle back on the original question, though, why do you think FICO chose to keep prices flat for so long and then decided to go ahead and start raising them?
For decades, a FICO score is priced at pennies for credit cards and maybe only a few dollars for mortgages. And that low cost removed really any friction for lenders, securitizers, regulators, and the credit bureaus to adopt and distribute it. And so, in other words, it was kind of a low cost strategy to help them reach the widest possible scale. And just to invoke Uber, I mean, it's similar to how they subsidized ride costs for years and driver compensation too, that allowed them to gain majority market share in different cities around the globe. And now that their position is more solidified, we've seen them start to raise prices to better align with the value they actually create. And so that's pricing power. And suppressing your pricing power for a period of time, meaning not making as much money as you possibly could, is a legitimate business strategy that can pay dividends down the road. And as such, that is how FICO can become a ubiquitous, utility like credit risk standard with powerful network effects once every investor, bank, and governmental organization benchmarks against the same number. Is the switching pains just become very difficult to swallow for everyone.
Finance is just, it's a complex sector in itself. And as you said, you don't want to be the one bank that basically chooses to only use Vantage score and then it goes wrong, right? It's just there's safety in using the benchmark, and FICO is that benchmark. And I think sometimes the simplest answer may very well just be the right one. I mean, it took them 20 plus years to entrench themselves enough to feel comfortable in their ability to raise prices without any consequences. And after successfully testing the waters, I think they feel emboldened to push even further. And that's currently what they're doing and what they have done in the past 7 years.
I think that's probably the right way to think about it. And on that point, if you were to try and imagine a transition that would take the most time to complete, I think getting banks, consumers, and the government to adjust to a new industry standard all at the same time, I mean, that would probably be the most bureaucratically painful process you could think of, which isn't to say that FICO's algorithm isn't also genuinely better than anything competitors have come up with. But they do have a wide moat where someone would have to come up with a dramatically superior credit scoring system. And even still, that might not be enough to overcome the red tape and inertia required to rewrite decades of institutionalized processes and best practices. And the way it works is that the big three credit bureaus collect a fee from lenders and remit a small royalty to FICO while keeping the bulk of the fees for themselves. So the credit bureaus are also very good businesses. And for FICO, choosing to leave their royalty split low for almost 3 decades maximize the credit bureau's margins and probably reduce their incentive to push further on an in-house alternative before FICO could become too mainstream. And I mean, that's what happened. The bureaus did join together to launch Vantage Score in 2006, but it just gained very little traction because FICO was so cheap. And had FICO raised prices earlier, though, I mean, that competitive threat from Vantage Score would have been taken much more seriously and could have led to much more disruption. And maybe just the last point I'll make here, and we kind of touched on it briefly, is that because FICO scoring is effectively required for conforming mortgages, aggressively pricing them could look like price gouging and taking advantage of the fact that Fannie Mae and Freddie Mac have designated FICO as this trusted intermediary. So instead, I think it's fair to say management chose to fly below the radar, especially once the FICO score became embedded in the mortgage process in the mid 1990s, basically not wanting to abuse this incredible advantage that had been gifted to them. And not coincidentally, the moment FICO began taking price in 2018, Department of Justice opened an antitrust probe against them, and the FHFA rewrote the rules for Fannie and Freddie to allow them to use Vantage Score. While Congress also started pressing the company on costs. So there's been a huge benefit to shareholders as FICO has dramatically raised prices since 2018. But even if it hasn't come in the cost of sales volumes, it has come at the expense of regulatory scrutiny, essentially.
Okay, so we talked about why they could raise prices and why it didn't really affect the business in any negative way, at least not materially. But why did FICO decide to start raising prices then? I mean, it sounds like a situation where if something isn't broken, you don't need to fix it, right? And maybe some small amount of price hikes is okay, but to push the gas pedal pretty much all the way down seems like an obvious way to attract the wrong kind of attention, right? And I think they have done that. So considering that FICO is mostly a US thing and they are not an international company, I assume volume growth probably matured, right? I mean, the results since the price hikes have been fabulous, but you have to wonder if that comes kind of at the cost of their business long term. And if it pressures regulators to rewrite the status quo, there has to be a certain reason why they choose to go with these aggressive price hikes.
I wouldn't disagree with you. To some extent, this is the reality of being a public company and the pressures that come with it. By 2018, I think it was fairly clear that adoption had plateaued, meaning volume growth alone could no longer move the needle. And obviously, after 25 years of not taking price, you could probably argue a sharp repricing was due just to account for inflation. And with FICO's role being firmly ingrained, I'm sure management felt like they could lift royalties without any kind of mass defections, and especially by calling it a special pricing plan, suggesting that they weren't going to do this every year. And yet, the early hikes were more than 25% per year. And as such, their wholesale mortgage fee rose to $4.95 this year, $4.95, which is up roughly 700% from 2018. And that number alone really is how FICO has gone from being a great business to own to an excellent one, the best of the best. And while revenues have compounded at just 10% a year since 2018, which is good, but it's not eye-popping, net income has compounded at a 27% CAGR. And I don't know about you, Dan, I've never seen anything like that, honestly. And when you account for share buybacks, earnings per share have actually further compounded at almost 31% per year in that time, which is why the stock trades at such a large premium in price to earnings ratio terms to the broader S&P 500. It's twice as much as the median S&P 500 PE multiple.
Those are just insane numbers. I think I now understand why the stock chart looks the way it does because I think I told you before, the first time I looked at it, I just thought FICO might be one of those companies that just benefited from the bull run in the last decade because the stock just skyrocketed since 2018. But I guess it was just one of those moments where they changed a little tweak in the business, and this time it was price increases that just totally changed the trajectory of the business. But what concerns me a little bit though, and I don't want to linger too much on the bear case, but I think it's something we should talk about, is that if you look at how the business compounded before taking price, total earnings actually shrank from 2005 to 2018, so for 13 years, and revenues just grew at under 2% a year. So you could say the top line was basically flat to up just slightly, while earnings actually contracted over 13 to 14 years. And that's not very inspiring. And I just say that or mention that because if the bears are right in thinking that FICO has mostly exhausted its pricing power, at least without a lot of fuss from regulators, then you're getting a company at 50 times earnings that actually historically hasn't been a compound of earnings, with most of that compounding coming just since 2018 as they've raised prices dramatically and as the market has paid just a much higher multiple of earnings to own the stock. And that just sort of rings the alarm bells for me because the back of my head just I'm thinking about owning the stock for the next 5 years out, and buying it in 2018 would have obviously been brilliant and contrarian, but I'm not sure if the same is still true today, even after the sell-off that we've seen this year. And I don't know, I don't really know what to think about it. And so what I really want to understand better is the moat, right? We always want to understand the moat, and this time I think it's even more important. And whether the moat is generally because of FICO's superior credit risk algorithm, and if it's just due to the fact that the government basically gave them a monopoly, because what the government can give, it can also take. And that's kind of the concern I have here.
Well, of course, FICO CEO Will Lansing believes the company's real moat is in the fact that it's the most predictive score of credit risk, plain and simple, in his opinion. And as he puts it, the moat is not some government conferred monopoly. That's not what makes us successful. That's how he worded it in one of the company's most recent earnings calls. And I would argue, though, that two things can be true. Of course, FICO's superior algorithm did help them earn their industry wide recognition independently. And from the data I've seen, VantageScore has narrowed the gap, but FICO's latest scoring models are still at least as good, if not better. And because of institutional inertia and the government mandating use of FICO in mortgages approved for Fannie and Freddie Mac, FICO's advantages were reinforced, allowing them to become really the standard language of credit risk in the US. And just to say that again, displacing an entrenched standard is extremely hard. And for decades, 90% of US lenders have used FICO scores when making consumer lending decisions. And over 95% of US credit card and mortgage securitizations for these, bundled loans sold to investors that we've talked about today, they reference FICO scores as the main measure of risk. And this universal adoption means everyone in the financial ecosystem speaks FICO. Lenders set interest rates or approval cutoffs based on different FICO ranges. Investors demand to know the average FICO score of loan pools. And even consumers check, what's my FICO score regularly? And I know I've certainly done it. And whenever I saw a Vantage score being used, like with Credit Karma, I would typically just be confused and wonder why it was slightly different from FICO. And ultimately, I just wanted to know my FICO score since I knew that's the one everyone else seemed to care about and go off of. And that is basically the definition of a network effect, which builds a self-reinforcing moat. The more institutions and people that rely on FICO, the more valuable and must-have it becomes.
I get it. I mean, it just makes a lot of sense. And we talked a bit offline about it. As long as it's basically in place with all the institutions out there, it just makes no sense at all. Also for consumers to get any other credit score. I mean, when you've used an apples to apples comparison for decades, it's just hard to change that. And I know before the podcast, Sean, we also talked about SAT scores in the US and how they're kind of like the academic equivalent of a FICO score. And yet there's been some turmoil because the way the scores are calculated has basically changed a lot over the last years. And there's naturally a bit of variance in how difficult the tests are from year to year, which is totally normal, without just using the same exact test. And so, anyway, as I understand it, the whole scoring system has been changed multiple times, such that in one year, a score of 1200 is a pretty good score. And in another year, it might be a poor score on the 2400 point scale. And that just makes it difficult to compare the academic quality of students over time at a university, for example, right? And you're trying to adjust the scores across a sliding benchmark, and that's just messy. So there's real value in having a reasonably objective and consistently calculated scoring system that rate everyone against whether that be with college admission exams or in loan applications. And that's pretty much what FICO just delivers, right?
Having a history of data that says, okay, people with a 680 FICO score have this percentage likelihood of default, while the percentage is this for a 750 FICO. And that history makes it easier and more comfortable to keep making decisions using FICO. And a new score might have a different scale or distribution, as you kind of pointed out with the SAT. And initially, there's also less of a real world track record to know how a given new type of score translates to risk and how predictive it is. And just because a new score says people are creditworthy doesn't make it so. It must be deeply evaluated and validated before the market will actually trust it, which I think adds to the challenge of displacing FICO. And the lesson from today is that FICO has a first mover advantage. In an industry so reliant on network effects, that really matters more so than in other types of businesses, I would say. FICO basically invented modern credit scoring, and they had a huge head start in doing so. And by the time competitors like VantageScore appeared, FICO already had 15 plus years of industry integration, data, and model refinement to give them a head start. And FICO hasn't stood still either. It rolls out updated versions roughly every 5 years to address new behaviors. And they've been able to, at least according to their own studies, predict credit risk more and more accurately with each new iteration of the FICO score.
I guess the problem for competitors like VantageScore, for example, is that credit scores are just way too important to make decisions based on factors like inclusivity. I mean, that might sound harsh, but when FICO scores are simply better, you have to use them. We talked about the financial crisis, and I would assume preventing a second one should be a little bit more important than trying to include as many people and credit scores as possible. And I mean, how much predictive power can be in a credit score that is based on 1 month's worth of data? And speaking of relevance, I've seen some articles which kind of give you the other side of the coin because the Wall Street Journal, for example, has put out an article which argued that FICO is becoming less relevant itself, which at first might make some sense. considering just how many more data points we have today. And that includes banks, merchants, and pretty much every player in the financial system. And I don't know, what do you think about it? Would you say those are serious concerns for FICO in the long term, or is it more for like short term noise?
So there have been some reports that FICO is becoming a smaller factor in underwriting decisions at JP Morgan and Bank of America. And who knows? Maybe that is probably true, but who cares? You might be surprised to hear me say that, but what I mean is that it doesn't impact the number of scores being pulled, which is what drives FICO's business. And in fact, FICO scores are referenced dozens of times in the annual reports of companies like Bank of America and JP Morgan. I mean, I checked that myself, and banks have a lot more data they can use to make underwriting decisions and monitor credit accounts with. So it's only natural that FICO's so called market share of the underwriting decision is lower than it was a decade ago. But I don't think that's the right way to think about it. I think that's the wrong framework. I mean, so at the same time, this doesn't mean that the FICO score isn't still used in each of those situations, which is what matters. It just means that banks are also using additional metrics to augment the FICO score now with. And the cost of a bad customer is far higher than the cost of a FICO score. And with banks paying up to $200 to acquire a lead for a credit card customer, paying a few pennies for their FICO score, which is a long proven metric, I mean, that is pretty negligible ultimately. Underwriting is a highly differentiated and often proprietary process for a lender. And sometimes you see firms bragging about going beyond just using traditional credit scores. But again, that's a different thing than not using credit scores altogether. And even if loans are not underwritten using FICO scores, originators still use FICO scores as a way of communicating someone's credit quality. So there's a bank, One Main Holdings, which Citigroup sold off in 2015. In their 10K, I saw that they noted, quote, while management does not utilize FICO scores to manage credit quality, we group FICO scores into the following categories for comparability purposes across our industry. And so another example of this is with Toyota's auto financing unit. Even though it originates loans using Vantage Score, they've admitted in disclosures to still using FICO scores to describe their loan pool to investors.
So then it sounds like the rare occasions where lenders do move away from using FICO, they still can't entirely escape FICO, right? I mean, and on that point, FICO has had a number of 20% drawdowns nearly every single year over the past 15 years from investor panics, while still crushing the broader market overall. And in each of those cases, these sell offs historically have been a great buying opportunity. And I wouldn't be surprised if that is once again proven true from today's prices. And to make this all more tangible, though, how about we talk about FICO's business segment breakdown and profitability? Because I feel like we talked a lot about the entire business, its mode, and why it's a great business, even its margins. But we did not yet talk about like deep into the business. What is it really that they do? What's the breakdown of profitability? So maybe you can give us some more color on that.
So FICO's business is roughly split evenly in revenues between its score segment, which is a part of the business we've talked about so far, and is what FICO is best known for, obviously. But it is also, they have a lesser known software segment that drives about half of sales too. But the credit score business is so much more profitable that it contributes to over 75% of the company's overall operating income. So you've got two segments that contribute equally to the top line, but shape the bottom line very, very differently. And it's funny because software is usually the more profitable part of most businesses, even if it's not their core focus. But for FICO, their credit scoring business is so good that it dilutes the overall business quality to move into B2B SaaS. And basically, FICO software business sells a platform and a package of apps for lenders to use in making decisions like whether to approve a loan, how much credit to extend, or reviewing whether a transaction is fraudulent. So it's distinct from the scores business, but I would say the software biz certainly leans on FICO score data and kind of complements it. And this includes everything from fraud detection to facilitating mortgage originations, collection software for managing payment plans for lenders, and customer communication systems like SMS and emails to communicate fraud alerts or payment collection reminders to borrowers. That is kind of everything that their software packages touch on.
So it sounds like the way to understand this is These tools complement FICO's core algorithm and scores by creating kind of like ready to go tools for lenders to use in better underwriting loans or identifying fraud sooner without hard coding logic across dozens of systems.
Right. But when we talk to people about investing in FICO, though, no one is really thinking about the software business. And granted, the bar is very high, but the software margins are just poor comparatively. Like it's hard to argue that this doesn't water down the business's quality and its golden goose. And when you have a business as good as FICO's scores business, it's hard to go into any new area without there being a dilutive effect. But still, the software business has 30% plus operating margins. So it's not a bad business at all. It's just that the scores business has nearly 90% operating profit margins, which honestly is maybe the most profitable business segment I've ever seen in any company.
90% is, is out of this world. And I think I now understand why the margins still seem comparatively low. I mean, don't get me wrong, FICO's margins are outstanding. But when we talked about the operating leverage of the business, I did wonder whether operating margins shouldn't be slightly higher than they actually are. And apparently they are significantly higher, but the software business basically dilutes them, at least to a small extent. And it feels like a good moment to just summarize what I understand about FICO so far. So what I think is the big question, from what I can tell, is how the government will set regulations for which scores to use for conforming mortgage loans. But even though the government has concerns, FICO still is very much the industry standard across many different types of lending. So even with non conforming mortgage with less oversight from the government, the private market has still largely preferred to go with FICO. And as such, FICO has been able to raise prices tremendously, as we discussed today, and quite to quite some extent, and making its scores business, as you just said, pretty much one of the most profitable business units that we've ever looked at because there are no incremental costs to do it. And they're just running data through an algorithm that was mostly developed decades ago and then marking up the price to license those scores to lenders or also to consumers like you who want to pay directly to see what their FICO score actually is. And in prep for our episode today, I tried to wrap my head around how cyclical FICO's business actually is. For example, does it map perfectly over the economic cycle, or do they have some ability to be resilient in recessions? And it looks like, according to an interview I saw with FICO's CEO, that the business has done pretty well historically, whether mortgage rates are high or low. But he told CNBC that today we're roughly 40% off peak mortgage volumes. And in terms of the number of mortgage loans issued, and as such, the company could have a major tailwind behind it over the next year or two if and when interest rates should come down. And I think we've just seen first signs that they might come down sooner than many people anticipated just a year ago. And all of that sounds very promising if you ask me. So I just wanted to basically run that by you and see your reaction. Is it kind of the whole picture, or do I get anything wrong?
When you raise prices the way FICO has been able to without any decline in volumes, I mean, it does look like you can survive any economic cycle. But just logically, I'd have to say that, of course, this business closely tracks the economic cycle and financial system long term. More people taking out mortgages is good for business, and fewer people taking out mortgages is bad for business. That is just a fact. And what we've seen is that with the ongoing price hikes since 2018, that has more than papered over any weakness in mortgage origination. But again, there's a real question of how much longer they can sustain price hikes for. If they stopped hiking prices today, you'd see the business immediately become much more cyclical, closely tied to the amount of lending activity that occurs in the economy. So maybe there's a perfect formula here where they stop taking price at the same time mortgage volumes pick up. But we have to recognize that these are cyclical earnings that can just as easily swing down over time, buried under price hikes. And I think the way to think of it is that, arguably, as much as 90% of FICO's revenue is exposed to financial services, making them, of course, very closely tied to credit market conditions. And during the great financial crisis, FICO's 2009 revenue was about 20% below 2007 levels, with scores revenues being down 27% as people applied for fewer loans. And recurring revenues from their software segment, I think, do help to balance this out. But that doesn't matter as much when, to say it once more, majority of the business's actual profits come from scores. It's hugely anchored to what happens with credit scores, which are very closely tied to the underlying economy.
It's pretty incredible though that FICO has had a hot streak of something like 7 consecutive quarters and maybe even more, where reported mortgage origination revenues in its core business grew at nearly a triple digit pace. I'm not sure anyone investing in FICO back in 2017 and even the most bullish of the bulls could have expected that.
And that sheer growth in mortgage scores revenues, driven by pricing actions, is bleeding over into scores revenue generally, with top line growth for the scores business breaching the 20% mark year over year. But scores for auto loans, credit cards, and personal loans have really added virtually nothing to incremental profits for years now. And last year, third quarter mortgage originations revenue were up 80% versus the year prior, meaning that mortgage origination revenue accounted for 39% of total scores revenue. But as early as 2022, it was probably closer to comprising no more than 25% of overall scores revenue. That is startling growth and business mix changes for what is otherwise such a well established company. And again, this is coming entirely from price hikes, particularly with FICO score checks for mortgage applications.
It feels like we just can't stop talking about it. But for price taking to be such a driver of growth like that, I mean, that's just not supposed to happen. It almost feels like it violates the laws of economics that we'd learned in school, right? And for them to raise mortgage fees from 60 cents, and that's 60 cents in 2018, to $5 today. I mean, you said this earlier, but for anyone doing the math at home, that's more than a 700% increase. That's just incredible in less than 7 years, right? Talking about all those numbers, I think it's time that we move on to discuss valuation, which is, of course, the most interesting and our favorite part of the show here, since we probably both agree that this is as high quality and profitable a company we've ever looked at, maybe alongside Visa, Universal Music Group, which we recently covered, and VeriSign, which you covered quite a long time ago on the show. And the pricing power, the stickiness, the industry adoption, the brand awareness, basically everything you could look for in a deep mode is here in FICO. So for even one of the best businesses in the world, you can overpay. And just this year, FICO shares have fallen from $1,900 per share to around $1,300 at the time of recording it. Yet the stock still trades at around 52 times earnings, which is well more than twice the average valuation of the S&P 500. And those are the best companies in the US. And if you trade at twice the valuation, it has to say something, right? I mean, I know that Sean, that Ps don't tell much just on their own because there are differences and assumptions about future growth embedded into these multiples. But the point remains that you're basically paying for a company to grow earnings per share twice as fast as the market average. And you have a company that has already done that for several years now and attracting much more regulatory scrutiny on pricing. So not to beat you to the punchline, but I'm going to be a bit surprised if you tell me that the valuation is really attractive here. And I'm not sure how far we are away from, seeing a very attractive valuation, but my gut tells me there's probably some more room for this thing to fall. Is that right?
Your intuition there is pretty good, Daniel. But just to walk everyone through how I approach the valuation, and you basically have two distinct business segments: the scores business and the software business. And within those, the software business includes subscriptions to their new software packages as they migrate customers off the standalone software they used to sell. And there's also this professional services consulting business where FICO would help customers customize specific tools for implementing FICO scores into their workflows, but that has become less and less relevant because it's more labor intensive and just less profitable and even more dilutive, really. And then in the scores business, you've got the pricing and revenues from mortgages, and then really everything else you can need to pull a credit score for, all bundled under that same score segment. And listeners should know by now that the scores business, generally speaking, is super high leverage, meaning that price increases directly ripple down to the bottom line, which is very compelling. But also, no one really knows how much further FICO can continue to raise pricing. I think that is really the crux of the bear argument, if you wanted to say it like that. There are a lot of financial analysts covering the company who are more optimistic than me, since a number of them expect the FICO score segment revenues to basically double over the next 5 years, just like it did from 2019 to 2024 after they first started raising prices. And And I guess I find that hard to believe with the regulatory scrutiny they've already gotten. I mean, scores doubled in those 5 years, even as mortgage originations have contracted because they raised prices so much. But now they have Congress and regulators breathing down their necks. So I just don't know if they can raise prices like that in the same way. So I'm skeptical, but I suppose the counter argument would be from the bulls is that we are in this period where mortgage borrowing is very depressed because interest rates have stayed high, while home prices really haven't budged much nationwide. And so maybe you could be optimistic that if and when the Fed cuts rates over the next years, that could spur an uptick in lending and mortgage origination that propels the FICO scores business organically without them needing to rely on price to the same degree. But still, no matter what, if you're going to project FICO scores revenues to more than double again, you're implicitly betting on a substantial degree of continued price hikes. And if that does prove to be true, paying a 50x PE for a company like FICO would not be as crazy as you'd think. But I mean, that's a really rosy set of assumptions that I would say does not leave a ton of room for error in that valuation or a margin of safety, as we call it. And especially as you have shifts in the competitive dynamics here, where for the first time, FICO's moat is maybe being picked away at, with VantageScore being used more in mortgages sold to Fannie Mae and Freddie Mac. And I think the short answer is we're just not sure yet how material that will be, but it is really the first sign of real competition for in years for FICO due to these regulatory shifts for a company that is otherwise not used to having any meaningful competition. So I think you're right to be cautious about not just continuing to project that they can double their pricing every couple of years for FICO score checks because you need a margin of safety larger than where the stock currently trades at, even after the already sharp decline this year.
Our listeners know that we always talk about how tricky and also dangerous it is to rely too much on multiples, and even just considering interest rates and everything like that into our investment thesis. It just doesn't help you much with the evaluation process, but it's certainly helpful to contrast a company's valuation with the overall market and with companies you might deem to be peers due to being in the same industry or for having a similarly high quality tollwood like business, which is why we talked about Visa and why we in some cases even talked about Universal. And on that point, when I think of dominant financial service middleman with deep moats, I can't help but think of the credit rating agencies, right? We talked about Moody's and S&P before, and they both have similarly high margins and they trade at a significant premium to the market. But even for them, their PE ratios are in the 30 to 40 times range. And the same is true for Visa, which is another one of those quality compounders in financial services. And FICO has the potential, from everything I've heard today, to go faster than all three of those businesses over the next few years. So a premium to even those names might be justified, but a few years down the road, once FICO has truly exhausted its ability to hike prices, and none of us know when that is, you would have to imagine that its valuation multiple would contract to align better with these other ultra high quality businesses. And then, of course, historically, you have the S&P, which trades at 15 to 20 times earnings, which is just a reminder to say that even when you're talking about a business like FICO, where growth is maturing and its multiple becoming more normalized, the implied valuation would still be twice that of the broader market. And the S&P 500 is, not your average index. Those are the 500 best companies in the US.
I mean, that's a really helpful context to provide listeners with. And in my model, I mean, that kind of lines up with the assumptions that you describe here. I think it's plausible that for a couple more years, they can dramatically boost revenues and margins just by raising prices in their score segment. But I don't think that can be sustained forever. And if by 2030 we have already seen limits to how much they can raise prices without triggering a revolt from customers or regulators, then the valuation should contract pretty substantially because we saw what this business looked like before price hikes. It was not nearly as good. And so, a rich price of 50 times earnings to, I don't know, 30 times earnings or less, that seems very plausible to me. And that reflects that this is a company that still earns massive excess returns on capital, but it might be hitting a growth plateau with more vulnerability to regulatory pushback or recessions in the economy that it was otherwise immune to over the last 7 years when it could just raise prices at no cost. So I don't want to bore everybody by getting super deep into the weeds of my model, but I think a reasonable fair value for this stock is maybe around $1,100 per share, with it becoming attractive to us to actually add to the portfolio with a proper margin of safety closer to $930 per share. And I should say the last time I called for a really high quality company to need to contract 30% or more was with the trade desk. And with that one, the stock promptly fell something like 40% overnight within a couple days of our episodes coming out. So I don't know, maybe we'll get lucky in that same way again and have a chance to snap up FICO below $1,000 a share. And, I should say for anyone who wants to actually see our models, because it's hard to appreciate what goes into them just over a podcast, you can do that in our weekly newsletter where we share full recaps and everything we talked about the podcast and more with the valuation models and the details about them. So there is a sign up link in the description below, or you can just visit theinvestorspodcast.com/newsletters to see the archive of write-ups and valuations on every company we've covered.
One of those companies is, as you mentioned, Trade Desk. And I think it's just a great example of why we are so cautious with investing in companies trading at high multiples, right? I mean, it's not that we disagree on the quality of the business, but we want to buy opportunities that feel at least a little bit asymmetric. And to find those, we need to have a relatively limited downside and then the optionality of positive surprises on the upside, right? And whenever a stock trades at a high multiple, most of the time, the optionality is already priced in. So the stock might keep performing well, but well, then you are left with all the decent returns it offers, but the business just can't keep up with the expectations. And then you're left with all the downside. And for a company priced at a multiple of 50 times, it doesn't take much to drop 20%. It's not like the business model needs to get disrupted or anything. It's basically just a headline about regulation or a single quarter in which price increases can't outweigh the stagnant volume to the extent that the market expects. And that alone would be enough to just send the stock tanking, right? And I know it sounds cliche, but investing is not a sprint, it's a marathon. And while we only had the chance to add, I think it was one company from our watch list, we still keep an eye out for them. And when they are more attractive, we can pick them up. So building a watch list, in my opinion, is just as vital of a part of building your portfolio. And we are doing that each week. And I think it sounds like FICO will be one of those companies that will at first will be added to the wait list.
Yeah, definitely a waitlist candidate. Well, I don't know about you. I kind of feel like that's enough on FICO for one day. How about we move along just to get a little preview of your pitch for next week?
Sure. I mean, just on FICO, I think this was as close to a finance company as you would get to without, your bias or not liking them, as most of our listeners know. But well, oftentimes you are the one bringing the high quality compounders that might still for prices a little too high for my taste, and I'm the one bringing companies that got beaten up a little too much for your taste. And I would say my next company though is in a similar ballpark to FICO, not as much market power, but a phenomenal compounder operating in a duopoly, and it is cheaper than FICO, but it's still far from being a bargain. The stock is down, I think it's 25% year to date, and one of the risks is something we have discussed in many other episodes as well, which is autonomous vehicles. And I think my last hint, because by now it's probably still a pretty difficult guess, would be that just like FICO, it recently made it into Francois Rochon's portfolio. So maybe that's a hint that helps people.
Okay. All right. Well, should be a good one, as always. Yeah, I think you tend to be better about bringing great ideas to the table where we don't have to wait for a huge contraction for the stock to become interesting. I bring a lot of great watch list names, maybe. But on that note, let me leave you all with a quote for some inspiration. Peter Lynch, the legendary investor, tells us, quote, when you want to buy in the second or third inning and get out in the seventh or eighth. With FICO, I think it's hard to say that we're at the beginning of the story, or where the company has a ton of runway and isn't broadly appreciated by investors. If you could have identified FICO's ability to raise prices back in 2018, that would have been a pretty early inning to jump into the investment thesis. And today, though, I have real questions about how long price hikes can be extrapolated further. See you all next week.
People just expect their cards to work anywhere, instantly, and with no hiccups. I think the uptime for the Visa network is 99.999%. That's just huge. So it's not enough to be good. A network must be absolutely flawless. And Visa has been perfecting this for decades. And finally, Visa doesn't just offer technology, it's also huge on incentives. So just last year, Visa spent almost $14 billion on incentives. So when you add it all up, global reach, brand trust, reliable tech, and then those direct incentives, Visa just becomes an obvious partner, even for those bigger banks in the world that might have the resources to build their own network.